studying your last two. I swim med when they turned in. The styrene down to mute. And can learn the pole that sunk he died.
Now that we understand how Trident tracks investment activity throughout the year, the next step is converting those activities into accounting records. This is where journal entries come into play. One of the most important principles in accounting is that every financial event must be recorded through a journal entry. In other words, investment activity by itself is not enough. For the activity to appear in the accounting records, it must first be translated into an accounting entry. Let's look at some examples. Suppose Trident earns interest income from a GIC or an investment account. From an economic perspective, the corporation has earned income and received cash. To reflect that event in the accounting records, a journal entry is created. Cash is increased, and interest income is recognized. Next, consider dividend income. When Trident receives a dividend from a corporation, another journal entry is required. Cash increases, and dividend income is recorded. Even though the transaction may seem simple, the accounting records cannot recognize it until the journal entry is made. Now let's look at mutual fund distributions. Unlike interest or dividends, a mutual fund distribution often requires additional analysis. The distribution may contain interest income, dividend income, capital gains, or return of capital. Before the journal entry can be prepared, the accountant must first determine the nature of the distribution. Only after the distribution has been classified can the correct accounting entry be recorded. Finally, consider the sale of an investment. When Trident sells an investment, the accounting becomes slightly more complex. Cash is received. The investment asset is removed from the books, and any gain or loss arising from the sale must also be recognized. Again, the transaction enters the accounting system through a journal entry. Notice the workflow shown at the bottom of the slide. Everything begins with an investment event. That event is converted into a journal entry. The journal entry is posted to the general ledger, and the general ledger ultimately supports the financial statements. This process is the foundation of corporate accounting. The accountant shown in the center of the slide acts like a translator. Investment activity happens in the investment world. Accounting records exist in the accounting world. Journal entries are the language that allows information to move from one world to the other. The key lesson from this slide is simple. Investment transactions do not automatically become accounting records. They must first be converted into journal entries. And once those journal entries are recorded, they become the building blocks of the general ledger, the financial statements, and eventually the T2 corporate tax return. In short, journal entries are the bridge between investment activity and financial reporting. Now that we've seen how investment activity is converted into journal entries, let's examine the most common investment-related journal entries used by Trident Investments Inc. Understanding these entries is important because they form the foundation of the corporation's accounting records and ultimately affect the financial statements and T2 return. Let's begin with interest income. Interest income is commonly earned from GICs, bonds, savings accounts, and similar investments. When Trident receives interest, cash increases and interest income is recognized. The journal entry debits cash and credits interest income. From a financial statement perspective, cash increases on the balance sheet, and revenue increases on the income statement. Next, let's look at dividend income. When Trident receives a dividend from a corporation, the accounting treatment is very similar. Cash increases, and dividend income is recorded. Again, the journal entry debits cash and credits dividend income. The result is an increase in cash on the balance sheet and an increase in revenue on the income statement. Now let's move to capital gains. This entry is slightly more complex because an investment asset is being sold. When Trident sells an investment for more than its carrying value, cash is received. The investment asset is removed from the books, and a capital gain is recognized. As a result, cash increases, the investment asset decreases, and income increases through the recognition of the gain. This transaction affects both the balance sheet and the income statement simultaneously. Finally, let's look at an investment purchase. This is an important example because it highlights a common misconception. When Trident purchases a mutual fund, stock, or other investment, cash is exchanged for an investment asset. The journal entry debits the investment account and credits cash. Notice what does not happen. No income is created. The corporation is simply converting one asset, cash, into another asset, an investment. The total assets remain the same, but their composition changes. This is why investment purchases do not appear as revenue on the income statement. The banner at the bottom of the slide highlights the most important lesson. Not every journal entry creates income. Some journal entries increase revenue, such as interest income, dividend income, and capital gains. Other journal entries simply move amounts between balance sheet accounts without affecting profit. As accountants, it is important to understand not only how to record a transaction, but also how that transaction affects the financial statements. A helpful way to think about it is this. If a transaction creates income, it will usually affect the income statement. If a transaction simply moves assets around, it will generally affect only the balance sheet. The key takeaway from this slide is, different investment activities require different journal entries, and each journal entry has a specific impact on the financial statements. Understanding those impacts is essential because the financial statements ultimately become the foundation for the corporation's T2 tax return. At this point, we have seen the most common journal entries used to record investment activity. But an important question remains. What happens after those journal entries are recorded? This slide shows the complete journey of a transaction through Trident's accounting system and demonstrates why journal entries are so important. Let's start on the left side. Whenever Trident earns interest income, receives dividends, sells an investment, or purchases a new investment, a journal entry is prepared. These journal entries are the first official accounting record of the transaction. However, journal entries do not remain isolated. Once recorded, they are posted to the general ledger. The general ledger acts as the corporation's central accounting database. Each journal entry updates one or more ledger accounts. For example, interest income affects the interest income account and the cash account. Dividend income affects the dividend income account and the cash account. A capital gain affects cash, investments, and capital gain accounts. An investment purchase affects investments and cash. Over time, the general ledger accumulates all of these transactions and maintains running balances for every account. Now look at the next stage. The balances in the general ledger flow directly into the financial statements. Some accounts appear on the income statement. These include accounts such as interest income, dividend income, and capital gains. These accounts measure the corporation's financial performance and contribute to net income. Other accounts appear on the balance sheet. These include cash and investment assets. These accounts measure the corporation's financial position at a specific point in time. Notice the color coding on the slide. Income statement accounts are separated from balance sheet accounts because they serve different purposes. One tells us how much income the corporation earned. The other tells us what the corporation owns and controls. Together, they create a complete picture of the corporation's financial health. Now look at the warning box on the right side. It illustrates a critical accounting principle. A single incorrect journal entry can create a domino effect throughout the entire reporting process. A wrong journal entry leads to an incorrect ledger balance. An incorrect ledger balance leads to inaccurate financial statements. And inaccurate financial statements ultimately lead to an incorrect T2 tax return. This is why experienced accountants spend so much time reviewing journal entries before preparing tax returns. The quality of the final tax return depends on the quality of the accounting records underneath it. The most important message on this slide appears in the banner at the bottom. Every number on the T2 return started as a journal entry before an amount appears on a Schedule 100, Schedule 125, or the T2 return itself. It first begins as an accounting entry in the books. That is why journal entries are not simply bookkeeping mechanics. They are the foundation of financial reporting, tax reporting, and corporate tax compliance. If the journal entries are correct, the financial statements are reliable. If the financial statements are reliable, the T2 return can be prepared accurately. And that is the ultimate objective of the entire accounting process.